in listen-only mode.
Well, good evening. It's Andre Ferdinands here, Top Stocks Managing Director. Thank you for joining this live webinar. I believe I've got Gary Davis on the line. Gary, can you hear me?
Yes, I can, Andre. Loud and clear.
Wonderful. Thank you for joining, Gary. And folks, there's only a few joining tonight, so we can make this webinar as quick as we need to, as long as we need to, but more importantly, we can ask very specific questions at the end, and Gary will be more than happy to answer any questions that come forward. I believe someone else has just joined as well, so Imre and Peter, welcome. Thank you for joining. This webinar, folks, is about dynamic investing. I'm going to be asking Gary, who, as you know, is our educational specialist, not only our educational specialist on the site, but I think a lot of members look to Gary as a specialist or an expert in many areas, and Gary has helped them, of course, not only through the specialist share education subscriptions which Gary offers, but also one-on-one advice through the forums as well. Tonight, we're going to be talking about, well, the questions I'm going to ask Gary are going to focus mainly about the turmoil that we see around the world. As you know, Greece had elections over the weekend, and we think those elections were successful for the world economy. Time will tell. But Gary has, over his 20 years, developed expertise in knowing how to handle turmoils and markets like the ones we're seeing now. You know, we've got Greece and Italy, and we've got Spain, Portugal. We've got a lot of countries. We've got the US over their 100% GDP in debt. Basically, the world is at a stage now that we haven't seen before. And tonight I'm going to ask Gary, well, what's his advice? What can he share with us on us making better trades, smarter trades, if you like? So Gary, if you're actually, Gary, did you just want to say a few words before I start asking some questions?
No, look, I'm okay. I think let's just explore where it goes. I'm really quite happy to talk about the whole topic of what's going on around the world, but really specifically, just what it is that investors can do. So let's get straight into the questions and see where we go.
Sure. And members, as Gary and I talked, if a question comes to mind, by all means shoot it into the chat box so that you don't forget it, and we can try and get to those questions at the end. So thanks, Gary, and appreciate again you taking the time out to help our members here. Okay. So Gary, let's start. I spoke about Europe. Obviously, you've got China as well, and China's going through potentially a slowdown too. You've got America that I spoke about. For some members, this is a concern. All of the turmoil is a concern. What can members do to protect themselves? How do you see these current events unfolding, and what does it basically mean for investors?
Okay. Look. Everybody is well aware of the fact that there are so many problems and issues in Europe, and I think the apprehension and nervousness around Greece and Spain and potentially Italy is certainly with good justification, because there's no question that they're in a serious amount of trouble. And I think investors, and I get the opportunity to talk to a lot of traders and investors constantly, and I think they're just getting a little bit sick of all the indecision, the overhang of what might happen. Do we go into the market? Do we not go into the market? And most people I talk to are really over the whole process. So it's really a matter of just working out how you can work with the current market conditions. The fundamental picture in Europe, unquestionably, is poor, and to my way of thinking, the only reason that stocks are where they are is because there's an expectation of central banks tossing a few $1 trillion more into the banking system. I think if that wasn't the feeling and the sentiment, I think you'd see stock levels a lot lower than where they are now. So I think we're certainly going to see ongoing problems in Europe, and I don't think it's going to end all that well, but really who knows when. It could be 6 months, it could be 6 years, and I don't think anyone really knows the answer to that question. There's also a lot of conflicting data and media coverage, which is adding to the indecision as well. So what I tend to do in circumstances like this is to just take a step back and ask myself some bigger picture questions. You know, I look at what what sectors in the Aussie market are well placed. So where the stocks are relatively cheap, the fundamentals are attractive, and the forward prospects look pretty robust. And when I look for those sectors, I keep coming back to gold, to mining services, particularly now that there's been a bit of a retrace in the price of the mining services companies, and also the IT sector. I think offers some really good opportunities as well. It's, you know, they've got a pretty good outlook, and they look fairly attractive at the moment. On the other hand, there's other sectors that look very expensive. I think energy stocks tend to look expensive and have done for a long time. You've got stocks like Oil Search that's trading on a price earnings multiple of about 50 times, which is, to me, just crazy. Another stock called AWE is trading on a PE of about 25. So there's some stocks there. There's some of the building materials stocks. I know James Hardie is on a PE ratio of about 20 odd. So there's really some sectors that look very expensive, or alternatively they're going through some real structural shifts, and probably the two most obvious examples of that is the retail sector and the media sector, where, you know, things have changed permanently, and you know, they're not going to go, this isn't a temporary correction, they're not going to go back to the old days. There's been a major structural shift there. So, you know, that's how I kind of see the current market conditions. I think there's still value, but you've got to be very selective about where you look.
Okay. So it's interesting you mentioned PE ratios then, Gary. The first thing that comes to mind when I think of PE ratios is Facebook. I think when they floated, they might even still have a PE ratio of about 100.
Well, look, I haven't looked at them for a week or so, but last time I looked, they were still, yeah, probably about 80 times earnings, which is just crazy.
It's crazy. So Gary, I spoke about China earlier. As you know, Australia is very dependent upon China's greed, if you like, or need for raw materials that we produce. How do you see things there, and the impact on Aussie stocks if there is a slowdown in China?
Okay, look, nothing ever goes. I'm kind of really a bit, not amused, but certainly intrigued by the way the media has jumped all over the issues in China, and a lot of people have gone incredibly negative on China. Nothing goes in a straight line, so some easing of the growth rate was not only to be expected, but really you'd actually want to see it. It's a required situation. I'd be pretty worried if there wasn't a periodic slowdown from where it's been, which is 10, 11, 12%, you know, down to maybe the 8% level. So that's the first point that I think, again, perspective, step back, have a look. If they're still growing at 8%, it's still a pretty good clip, you've got to say. I then look at companies like BHP and Rio. They know far more about what's going on in China than we do, and they're continuing to invest tens of billions of dollars. So obviously they don't feel that there's going to be a significant crash of the China economy or the Chinese property market. So to me, to project this normal kind of slowdown, this periodic slowdown that we're quite possibly seeing at the moment in China as being the end of our mining boom is really just plain silly to me. However, there is a large surge in iron ore supply. If we just pick out iron ore as one example, there's a very large surge in iron ore supply coming through the pipeline, and that's coming through at a time when the rate of growth in steel consumption may have peaked, and I stress may have, because, you know, reliable data out of China is not all that easy to get. I remember reading a report about 3 or 4 years ago, a very, very extensive economic study, which was done by one of our, you know, really preeminent business people. And it was all about the fact that China, and this was 3 or 4 years ago, had reached an inflection point where the consumption of steel and raw materials actually starts to take off exponentially to the upside on a per head basis. And I've never forgotten that report. And I think that's always got to be remembered as well, that China's at a point now where their consumption per head of population is really going to start to escalate, because they're going to want more cars, more fridges, more washing machines, and all those sort of things. So frankly, I'm not particularly concerned about the fundamentals of China. Yes, there'll be some ups and downs, but I think it's going to continue to grow and grow at a pretty healthy rate. There is some conflicting data there with the official Chinese GDP data. Is showing growth in the economy. There's some private data that's done by HSBC Bank that's showing slight contraction. So there is a bit of conflict in the figures, but my view is that the Chinese authorities will do what they need to do to maintain healthy growth. So if we can buy top quality companies when they're cheap, and particularly when sentiment towards China is a bit negative, then I think, as with an investor's hat on, I think we're in pretty good shape.
Okay. It's interesting you talk about that exponential curve. I think my teenage kids are just about to hit that with all the technology they have on their wish list at any point in time.
Yeah.
So, Gary, what should our members, what should investors be thinking at present? I mean, what are their alternatives?
Well, to me, there's two big picture alternatives, and this is a fundamental decision that all investors, I think, need to make philosophically. One is you either stay in cash completely, or you decide that you'll take on a bit of risk, whether that's in the property market, the share market, or wherever it may be. So I think fundamentally you've got to make that decision. Now, if you decide to stay in cash, my absolute conviction is that you are losing purchasing power now, because if you look at what the Australian 10-year government bonds are paying at the moment, I can tell you that that you're going to be losing purchasing power in real terms. So I'm not a big fan of cash. So I think investors need to make that decision, and if you take the decision that we've got to take on board some risk, we've got to invest in assets of some sort, then it's really a matter of deciding how do you minimise the risk while producing a suitable return. And to me, term deposit is probably not, or government bonds is probably not a suitable return.
Okay. So I've just noticed, Gary, there's a question there which I'll try and get to in a moment, but let me just while we're on this subject. So if investors are prepared to take on a bit of risk and they're looking for safer income returns, what sort of lower risk alternatives are there out there?
Okay, look, it distresses me a bit. Many people have been advised over the years, and particularly of late, to buy traditional blue chips and hold on to them is one avenue. The other avenue that's really come to the fore in the last year or so is to go and buy government bonds. Now, with respect to government bonds, this is the worst time to buy bonds in probably 3 decades. So my overwhelming recommendation is, do not do it. That is the worst possible investment you could make to go into bonds at this point in time. To me, it's the equivalent of buying the ASX 200 when it was near 7,000 points. To me, it's the equivalent point in the market. And the reason for that is that you're getting about 3.5% at the moment for a 10-year bond, and you know as well as I do, and I'm sure the members on the call here know that energy costs, healthcare costs, petrol costs, food costs are running at more than 3% a year. I think everybody knows that and accepts that. So to me, if you go into bonds, it's just a really bad point to do it. You are probably highly likely to lose capital value, so the value of the bonds is going to go down, and at the same time you're virtually guaranteeing yourself that over time you're going to lose purchasing power. So to me, bonds are a really bad way to go. Looking at blue chips, most blue chips have provided no capital growth in the last 5 to 7 years. Now, if you look at any of the major banks, you look at BHP, you look at Telstra, you look at Wesfarmers, any of those stocks, if you go back between 5 and 7 years, you'll find that where they're trading now, the share price is the same as it was in 2004, 5, 2006. So holding those stocks for the long term, to my mind, is a very ineffective strategy. So they're two very, very firm views that I've had for a long time, and I see absolutely no reason to change that. And one of the things that that concerns me a bit at the moment is that there's a real value trap in some of the really high dividend stocks because they're also very high risk. And they're very high risk because there's a lot of profit downgrades around and there's plenty of dividend cuts around. And if I can just flash over to a to this graphic or this this PDF, and this is a listing of in descending order of shares, blue chip shares or supposed blue chip shares that pay the highest dividends in the Australian market. So I just want to quickly run down here just to give you a sense of where we're at. Now, Seven West Media is paying 15%. Now they've just come out with a profit downgrade, and the share price has probably lost 60% in the last year. David Jones, retail, in a similar kind of situation. Myer paying nearly 10%, but profit downgrades there, and the price is heading south at a rate of knots. You've got APN News Media, similarly, the share price has lost a huge amount of ground. We scroll down a bit further and we get down to Air New Zealand, which is paying about 8.5% dividend, but I wouldn't buy an airline stock with my worst enemy's money. And it's not really until you get down to some of the banks, and we've really got to come all the way down here. We've got JB Hi-Fi paying nearly 8%, but my gosh, that's really a stock in a lot of trouble. You've really got to come all the way down to Telstra, down around 7 or 8%, and Westpac at about 7%, before you start to see any kind of stock that you'd actually want to own, where there's not a hell of a risk of capital loss, or the dividend that you thought you were going to get, you're not going to get it because they're going to have to cut back. We see a stock like Qantas, which used to pay a reasonable dividend. They haven't paid a dividend now for 6 years. So there's a real value trap out there that I'd really, really caution your members that are maybe thinking about thinking about chasing some higher dividend yields. Again, be very, very careful in that area. To me, there's I look for true value stocks. They're stocks that are in really good shape. They possess certain key fundamental financial elements that set them apart from other stocks. I've gone through virtually the entire ASX 500 and combed through everything, and there's really only about 20 stocks on the Australian market that meet the criteria that I look for. So, it's a very strict criteria that I use. Most investors only think about what stocks to buy, and they hope that it goes up. And they don't really consider the merit of the underlying business, and that's really what you need to think about: the stocks you're buying as a business, and whether you want to own that whole business. And I'm sure if your members have tapped into this sort of information very much, that's a sentiment that's been expressed plenty of times by lots and lots of people that have been successful investors. But just looking to use that approach, so the sort of parameters that I use, I look strongly at return on equity, I look at earnings per share growth, I look at very low debt levels. All those sort of things are the attributes that I look for. But if you just use that approach and nothing else, the price still may not move in your favour. So being just a fundamentalist to me is not the answer. So yes, I've got a selection formula, but I look to enhance that formula substantially by using price charts to help me with entries and exits. So, so a bit of a long-winded answer, but bottom line, I think investors need to be highly selective these days, looking for characteristics that most people don't look for, and to really understand the prospects for the sector that the stock is in. And earlier I talked about the sectors that I believe look cheap on fundamentals, and you know, that's where I think you need to be looking.
Okay. Welcome Ian, by the way. We've had another member join. Welcome Ian to the call, and at the same time Imre has put a few questions there, Gary. We'll get those questions. I've just had a quick read of them. They look very relevant, and I'll try and get to all of those questions at the end.
Okay.
So Gary, what about the broader approach, though, to growing wealth? You've talked about dividend yields, etc. What about the broader approach?
Okay, well, look, there's no single strategy is ever going to work under all the different kind of market conditions. You definitely need a toolbox approach, and you use or put emphasis on the strategies that are appropriate at the time. I've been really going heavily towards stocks that are going to give me strong dividend growth over the next 3 to 5 to 10 years, and they're not the traditional names, I can assure you. But they are stocks that have demonstrated not only really strong financial performance, but consistency, and that's the thing that I look for, is consistency in results over at least 5 years, and even better if it's 8 or 10 years. So I'm looking to buy quality stocks during corrections and panic sell-offs. So that's an element of the approach that I take. The other element that I'm moving more towards as well is really generating passive income, and there's some pretty exciting opportunities in that area when you start to really understand the possibilities. And of course, using cash, you know, just from time to time, if the market is really rocky, then holding part of your assets in cash is obviously a worthwhile thing to do as well.
Okay. You mentioned dividend growth. Can I just explore that for a moment? What do you mean by this? What are the sorts of returns that are possible there, Gary?
Okay. Well, this approach is the approach that Warren Buffett's used for the last 45 years, and I don't think anyone doubts that that's a pretty robust sort of strategy. So really it's just following that same approach. I'm trying to identify, not by stocks, but trying to just identify really superb businesses, and if you do that and you get in at a at a sensible price, then most other things tend to take care of themselves. I think investors have been a bit shell-shocked since the GFC, and they're increasingly focusing on things other than just the capital gains. They're looking for dividend streams as well, and perhaps have dialed back their expectations for capital growth. So what I look for in the stocks, as I mentioned before, is strong and consistent financial performance over at least 5 years, which gives us then at least 10 reporting periods, because these stocks are reporting every 6 months. So to me, if you can get financial performance at above certain benchmarks that I set, and you can get it consistently for a lengthy period of time, then that gives you a very good chance that it should continue into the future, as long as that sector is still sitting in the right place in time. I look for robust cash flow, so I'm talking free cash flow here. This is not; these are not profit numbers that accountants can fiddle. I actually want to see good growth in free cash flow, which is the money that's left over after the company has run their operations, done all their reinvestment, and spent all the money that they need to spend. So that's a key one that I look at. And if you use that formula based around return on equities, then you're going to find that there is strong and reliable growth in dividends. One follows the other. as long as the directors of the company have a view to treating shareholders well. And again, all you need to do is look at the growth in dividends that the company has paid over the last 5 years. And I want to see not 2% growth in dividend from one year to the next. I want to see 10 or 15 or 20% growth in dividends year on year. Now, there aren't many companies out there that meet these criteria, but there are some, and that's the key. And look, I've got a couple of examples that I just had prepared. So maybe if I can just run through a couple of examples, Andre, might be the best way to explain it.
Yeah, sure, yeah.
Okay. So as I'm just going to give a couple of examples, I just need to, for licensing reasons, just mention that this is all just general advice. So, please, your members shouldn't act on this information at all, because I obviously don't know their financial circumstances. But look, there's a couple of stocks that have just been fabulous performers for more than a decade. And I don't think anyone can question the financial performance of these stocks. First one is Monadelphous, and I'll just give you a quick snapshot. And whilst there's been some fantastic capital gains here, to me the real prize has been the strong growth in dividends. Because in 3 to 5 years' time, I don't want to be worried about what the market is doing. I want to have a really healthy and robust dividend stream coming in so that it doesn't actually matter to me that much whether the market's going up or down, or there's an election in Greece or whatever it might be. So let's have a look at Monadelphous. If you'd bought it in January 2006, you would have paid $5.50 for the stock. And since then, it's paid you almost all of your original purchase price back in dividends. So you almost own the stock for nothing. Now, the current dividend that's paid on what you originally bought the stock for is about 24% per annum. So that's a pretty healthy growth in dividends. Now, along the way, you would have made 382%, even if you'd sat through the GFC. Now, I'm not saying that you would have done that, but even if you'd sat through that hugely tumultuous period, you'd still be nearly 400% up in terms of capital gain. Let's wind forward and come post the GFC. Let's say you'd bought in 2009 in March, which was pretty obvious the market was turning up then, and you would have bought then at $7.80. Now, the dividends paid since then have been $2.72 in total, and you'd be receiving the current dividend on your original purchase price of about 17%. So whether you bought 5-6 years ago or whether you bought after the GFC, they're still pretty attractive numbers. And you would have made nearly 270% in capital gain. So there's one example. One of my other favourite stocks is a company called ARB Corporation. That's one of the biggest four-wheel drive equipment. In fact, it is the biggest four-wheel drive equipment manufacturer in the world. And if you'd bought these, again, January 2006 for $2.60, you would have got nearly or a bit more than half your money back. The current dividend on the original price is 11%. Seems a bit skinny, but what this company does is every 3 years or so, they pay a special dividend, which is usually a really big one. So if you average that in, that would actually be higher. Again, capital gains, more than 300% during that period. And if we look at the same time period, purchasing post the GFC, the dividends paid are still pretty attractive, and so is the capital gain. So they're just a couple of examples of the sort of stocks that I look for. And if you looked at the financial performance on a 6-month by 6-month period, going back in time, basically to the start of this century, you would find their financial performance is absolutely pristine. So they're the kind of stocks that I look for, and because my performance criteria is so tight, that's why I don't have very many that fall into that category.
Okay, they're very good examples. So what about passive income, Gary? You talked then about dividend growth, but what about passive income? I know this is also of great interest to our members.
Okay, well look, if you're an investor looking for a higher level of regular income, I'm really excited about this. This is a process that's been around for a long, long time. I've, over the last decade, have not given it too much time or thought because I pigeonholed it as not being particularly productive, and it's always dangerous to pigeonhole things and kind of close your mind to the possibilities. So I've been revisiting this of late, and the market conditions we're in now, I think, are just perfect to roll this kind of strategy out. There's regular payments, they're higher than term deposits or blue chip dividends, and to my mind, you're actually taking less risk than owning the same blue chip shares. And what we're really doing here is boosting the normal dividend return via doing something called writing covered calls. Now, some people understand what that means, others, don't. But if you do understand a little bit about what writing covered calls is, just keep an open mind, because there is a way to do this which is, in my view, very attractive under the current conditions. And in fact, you can earn a monthly income stream without even owning the underlying share, which is a pretty interesting concept. And right now, if we look at BHP as an example, then you can be generating at the moment about 2% a month from this additional process. That's in addition to the normal kind of dividends that the stock pays. So that's pretty attractive. Now that's not a projection that you can produce that every month, but certainly that's where the market is sitting at the moment. And the best thing about this is that the worse the market gets, the better this process works. So a good old market crash is actually outstanding for this kind of approach. So that's kind of it in overview.
Okay, so covered calls, especially to me, is quite new. I'm expecting that some of our members may struggle with understanding it as well when they listen to this recording when I put it on the site. Can you just take us through a little bit more, and maybe do you have an example there, Gareth?
Yeah, I do have an example. It's a big topic, and I can't do too much to really explain it in detail. But perhaps just by giving an example might be the best way, just to open the door a fraction on what this is about. But basically, writing covered calls is you're in the options market, and when you're in the options market, you can either be a speculator, which is quite a higher risk thing to do, or you can be effectively a risk manager and an income generator, which is completely at the other end of the spectrum and is about the most conservative thing that you could possibly do. So I'd like members to really take that on board, that this is the absolute conservative end of the spectrum. So what you can do is to gain extra premium by giving someone the right to buy your shares under terms which are advantageous to both parties. And that's the key here, that it's a win-win scenario. So if you want to own blue chip shares like Commonwealth Bank or BHP or Telstra, then you may as well know how to buy them below the current market price and also get paid an additional amount as well. So if they're the kind of stocks that, and I know a lot of people buy the banks for their dividend because it's, they're paying 6 or 7% a year dividend. So if you're going to own the stock for the dividend, then why not just get paid an extra amount? You're not taking any more risk, and in fact, as I said earlier, I think you're taking less risk. And I think the market conditions we're going to see for the next 5 years are going to be ideal for this, because my bigger picture view is the next decade is going to be a repeat of the 1970s, where effectively prices went all over the place, but by the time we got to the end of the decade, they were about the same as where we started. I think we are already seeing a repeat of that. We've seen no capital gain in the major stocks for the last 5 to 6 years, and I think that's going to continue into the future. Now, these premiums come to you cash up front in your bank account. They occur either monthly or every couple of months, along with the regular dividends. So it provides additional cash which you can either compound or you can access it now for cash flow if that's where you're at. So let me give you an example using BHP, and these are some figures from just a couple of days ago. So when I prepared this, the current price of BHP was $32. There's plenty of uncertainty around, so we may not necessarily want to buy BHP at the current price of 32 because we're apprehensive about what might happen in Europe or in China. But if worst case scenario came around and we had to own BHP at $32, it's probably not a bad long-term investment. But there's a way that we can work with this. So what we can do is to start by actually writing some put options, which is basically giving someone else the right to sell you their shares, and they're buying this insurance, if you like, for their own protection. So it's like insuring your car or your house. They're buying put insurance to protect the value of their shares, and we're selling them that premium at a price which is equal to or just below the current market price. Now, you could sell someone the right to, or effectively sell them a July $31.50 put premium. So the premium of this option is just a little bit less than the current share price. Now, at this stage, we do not own the shares. And at the moment, that option was paying, when I prepared this slide, that option was paying $1.07 per share. Now, really critical that you need to have the cash available to buy, and let's say for the purpose of this example, 400 shares. So you don't want to do this if you don't have the cash available and you are willing to buy the shares at $31.50. So this is a very, very conservative, low-risk strategy. So to do that any other way is actually taking quite a bit of risk. So you need to have that cash available, which would be about $12,800. Now, if the price of BHP stays above that $31.50 mark by the time the option expires worthless, or expires at the end of July, then effectively the option will expire worthless. So you would have received $428, which is the $1.07 times 400, effectively 400 options, minus the brokerage, which is $35. So that would be a return of $393. Now that's a 3% return in 5 weeks. Now effectively what's happening here is that you are benefiting from time decay of options, and 90% of options expire worthless. So that's a pretty attractive return in just a matter of 5 weeks. So we've got to the end of July. You then say, well, okay, if depending on what the market conditions are, we can repeat this process for August, and we can sell someone another premium at a different strike price in August, whatever is appropriate given the market circumstances. And we don't really care whether the share price has gone up or down. Now, if the price looks like closing below $31.50 in the last week of July, then we can either allow that option to be exercised, in which case we are then buying BHP shares for $31.50, so we're buying them from the person who holds the option, minus the $1.07 that we've received in premium. So in effect, we're buying BHP for $30.43, which you've got to bear in mind that the current price is $32. So we're actually being able to buy it nearly $2 beneath the current price. So if nothing else happened, we've been able to buy BHP at significantly lower level than what we would do at the moment. The other alternative is that we can take action to effectively roll the contracts over, and in doing so we can gain a little bit more premium and effectively prevent ourselves from being exercised. And if the price of BHP keeps falling, we can just keep repeating that every month and until we get to a point where you're quite overjoyed to be buying BHP at, perhaps $25 or $26. Now, I don't know how this will play out, but I don't actually care because it doesn't matter what the market does, and that's the important thing here. So let's say the price has, let's have a good old market crash, and let's say the price has collapsed down to $25. Once the market stabilizes and we decide that we're very, very happy to own BHP at $25, we can then start doing what's called writing covered calls. So all that's happened up to date is we haven't owned the share, we haven't been exposed to any potential capital loss, and all we've done is we've collected some premium until the price has got to a level where we're comfortable buying it. Once we get to that point, we can then start to write covered call premiums, and if we then wrote an October $27 call, which is in 8 weeks' time, at the moment the premium on that call is $1.80. Well, when I prepared this slide it was. So the premium you'd receive would be $1.80 times the 400 options minus your brokerage gives you $685. Now there's also a dividend due on BHP on the 5th of September, and that dividend is 55 cents per share. So there's another $200 that you'd be receiving as well. So if the price of BHP stays below $27 at the 30th of October, then you would have received the $685 from the option premium, the $220 from the dividend, which is a total of $905. You add that up and that's a 9% return in 8 weeks. Now in no way am I saying that you can just roll from one of these to the other and you can produce this kind of return every single period, because it depends a bit on what the market is doing. But when you can produce these sort of returns in relatively short periods of time, you can see it's pretty attractive. You don't actually need to turn it over that many times a year to really boost your income. So then at the end of that period, if the price is below $27, then we just repeat the process for December and we just keep doing it depending on what the market conditions are. If we happen to get exercised, in other words, if someone wants to buy our shares at $27, then all that's going to happen is we're going to lock in a $2 capital gain per share times 400 shares. So we lock in an additional $800 capital gain. Now, if the price looks like closing above $27 in the last week of October, then we can just roll the contracts over and gain more premium. So really we can really decide depending on what the market conditions are doing, and we just keep repeating that until eventually we reach a point where we're going to lock in some significant capital gain. Now I hope this isn't too confusing for listeners. It's a big topic and a big subject, but there's a very simple way to do this. So the net result for BHP is, and it's important to recognise here that you've got to be prepared to own the share at all times. So that's the key here. But the reality is that you can avoid owning the shares until you're ready under most circumstances. Not 100%, but under most circumstances you can avoid owning the shares until you are good and ready to own them. You're guaranteed the monthly or bi-monthly income plus the dividends for obvious reasons, because that's money that's paid up front. It is yours. No one can take that money off you. The worst that can happen is that you can be exercised and either forced to sell your shares for a profit or to buy your shares for less than you otherwise would have paid for them. That's the worst that can happen. So it means you either lock in a profit or you buy the shares at a price that you're pretty happy with. And the key thing here is that you no longer care what the market does. It doesn't matter. It doesn't matter what's happening in Greece, what's happening in Spain, whether the market crashes. It doesn't really matter. And this is not a particularly time-sensitive exercise, so you don't have to watch the market. You don't have to be concerned about what the market is doing on a day-to-day basis. And the biggest thing for me is that the worse the market is, the better this strategy works. And that's why I think it really is coming into its own, because I just can't see that the next 2, 3, 4, 5 years is going to be a bed of roses. I think it's going to be volatile, it's going to be unpredictable, and there's going to be a lot of uncertainty around for quite a period of time. So, you know, I am really quite excited about this strategy. Sorry that was a bit long-winded, but I thought, you know, giving you an example was perhaps the best way to do that.
Oh, thanks, Gary. I mean, it's certainly a wonderful example. I mean, I never knew to this extent that you could pretty much lock in profits whether the market's going up or down. It's I think our members are going to find this very interesting when they go through this on the site.
Yeah, look, I think for investors that are, you know, that really are focused on income on a regular basis, I think this could be a real game changer for a lot of your members.
Okay. So Gary, what else is important for our investors, you know, to be aware of as they try to protect or build their wealth here?
In my experience, that I've had the opportunity to work with, you know, literally thousands of people over the last 10 or 12 years, and the hardest thing is for people to stay on track, even if they've got good strategies, whether it be in the trading arena or in the investing arena, because most people don't have a plan to deal with the market upsets, and that's really, really important. And one of the things that I really struggle with in the educational side of what I do is to actually get our members to actually define what it is they want, and then help, you know, with some help, build a coherent trading plan around that, or an investing plan. You know, everything to my mind needs to be pre-planned. At the moment, I'm factoring in some pretty volatile conditions. I don't know what will cause them. I don't know when they will occur. I just know that they are going to occur. So all of my structure is really heavily about risk management. The reason that I think a lot of people struggle to stay on track is that the media bombards us, and we all have our own biases about what we think should be, and it makes it very hard if you're out there as an independent investor. It makes it very hard to consistently do what you need to do when it's required, because fear and greed just get in the way. And so that's really the main thing that I bring to the table with my you know, with my members, is providing a clear perspective on the market and helping them to execute the strategy reliably. You know, and I just find that there's a relatively small percentage of investors and traders that you can give a strategy to, and they can actually execute it, because the market is constantly evolving. Just as an example of you know, the perspective that I've been able to help our members with, we bought BHP in November of 2008 at $21.50. Now it touched $20 for a day and then rebounded. It wasn't because I had a crystal ball. It's just the pattern to me screamed that the price had gone far too low and was reversing. And within a week, BHP had gone from $20 back to $30. Now that's a matter of public record. We also bought a lot of quality small caps between March and June of 2009 that have been absolutely smashed. So I'm not talking about theoretical stuff. This is the market perspective that I've been able to provide to our members.
Okay. I'm just conscious of time here, Gary. I think we may only have 10 minutes left, so I'll quickly go through this last question that I wanted to ask you, and that was very simply, where do members go for more information on this?
Okay, well look, we're running a general information webinar next Tuesday night on the 26th, and that'll give investors an opportunity to have get a bit more information about this whole topic and the option side of things. And what we're going to do at the end of that webinar is to give investors an opportunity to come in and experience what we do. So they can, we're going to give them a free trial period with full access to our program for a period of probably about 6 weeks, which will be long enough to fully evaluate what it is that we're doing. So rather than try and teach people or explain to people how to do this, I'm going to allow them to experience it and pick it up over time. So that's probably the best thing that I can do for them, I think.
Okay. So the 26th of June, Gary, for the members that have attended today, anything special for them? Maybe an extra week or something like that to put you on the spot?
Yeah, look, that's no problem, Andre. I mean, the important thing here is we want to give investors the opportunity to make up their mind in possession of the facts. You know, if Top Stocks members would like a little bit of extra time, you know, that's okay.
Wonderful. No, well, I'm sure they appreciate it, Gary. Gary, we've got a few questions here from Imre. Are you happy in the last few minutes just to try to address that?
Yes, certainly.
Okay. So the first question Imre raised was about franked dividend paying stocks for long-term income and investment, and you mentioned IT and mining earlier as well for companies for growth. Just want to try to answer that.
Look, certainly they're the sectors, and throwing gold, you know, high quality gold producers as well. They're the sectors that I believe are going to be good areas, and there's a couple of industrial stocks as well. But even within the sectors, you've got to be highly selective about the stocks, because let's just look at the mining services area. There's probably 20 odd stocks that I research and monitor thoroughly and on an ongoing basis. Yet there's probably only 5 that I'd want to own. In the IT space, there's probably only, again, 1 in 5 or 1 in 10 that I actually want to own, because they've got the kind of robust financial performance that has stood the test of time. So for me, I'm not prepared to take any risks with stocks that are questionable, and my focus is on getting the best companies I can, and if I can do that, I know that I'll get a good dividend stream. So I don't come at it from the angle of looking for a good dividend stream and hoping the company's a good one. I come the other way and I pull the company apart and make sure that it's a great company, and if they are and they treat shareholders well, then the dividends and the capital gains will be there.
Okay, and that, Gary, is independent of whether the dividend is franked or not?
Yeah, look, I don't look too much at the franking side of things for a couple of reasons. With this passive income strategy, that kind of really changes the rules of the game quite a bit, because then franking becomes a little less important. Also, too, if people are doing this inside of, say, a self-managed super fund, then the franking credits are not as valuable as they are outside of a self-managed super fund. So it depends a bit on, you know, how you're operating your account there.
Yeah.
But fundamentally, I concern myself very much with the quality of the business, and I don't, you know, I know that if I get that right, then everything else follows, rather than concerning myself with the current level of dividend and what the franking credits are about. Because we've already seen it, and in the next 6 months or a year, we're going to see a lot of dividend cuts, and there's going to be a lot of investors very disappointed. Okay.
And there's another question there from Imre asking about overseas stocks, Gary, and while you're considering that, overseas government bonds as well, because obviously in some of the European countries the returns and percentages we're talking about are far different.
Yeah, well, I guess I wouldn't be buying Spanish government bond yields at 7% at the moment, or Italian yields at 6%, because you're probably going to your capital return is going to be more of an issue, I think, than the yield. Look, when it comes to overseas stocks, I think fundamentally it's quite a reasonable thing to do, because Australia does have limited options in terms of really high quality stocks. And I mentioned earlier that there's probably no more than 20 stocks in this country that I would want to own in terms of great businesses. So fundamentally, I agree with the concept of going overseas to own those stocks. However, I prefer to be very focused at home. I don't know enough about those overseas companies to be really sure about what I'm doing. I can make a very handsome income here with these 20 or so stocks, plus some gold stocks, plus the passive income strategy. You know, I don't need to go overseas. But in answer to the question, fundamentally, I think it's a sensible thing to consider. I always worry about exchange rates and all those sorts of things as well. And you know, perhaps dealing with brokers that aren't locally based, and so there's some. I've never done it, and that's maybe that's to my detriment. But there's some of the reasons that I've kind of just stayed in my own backyard.
Okay. I can't see any more questions coming in, Gary. So I'll just pause for a moment there. Ian, Imre, Peter, anyone else on the call, if there's any more questions you'd like me to ask Gary, please shoot them through. Otherwise, I will thank Gary sincerely for his time tonight. I can see you're putting up some links there, Gary, on how to register for the June 26th webinar. Gary, now we can put this up on the site for all Top Stocks members to see and to hear what we talked about tonight. Yeah,
look, I think it's a pretty big link, so I think the simplest thing to do would be when you pop this recording up on the website, if you just want to put that registration link underneath it. Now, wonderful. I think I've given you the wrong time there for that webinar, but anyway, the details, I don't think it's 5 p.m. Australian Eastern. I think it's a different time, but anyway, that detail will be on the registration page. Sure. That may well be Perth time, but Gary, thank you so much for your time tonight. Team, I'd like you to also acknowledge Gary runs a lot of webinars. He runs some specifically for Top Stocks. He's our resident educational expert. He has quite a significant following on the site. Thank you for your time tonight, Gary, and hopefully we can do this again soon. It's my absolute pleasure, Andre. Thank you. Thank you. Thank you, members, as well. Cheers. Have a good night. Good night.